Every great options trader that I've ever met finds that market massacres like the coronavirus sell-off that's taking place presently are sources of incredible options trading opportunities, but you need to know where to look for them and how to take advantage of them. I'm the head trader of SMB Capital's options trading desk, and right here at SMB's trading floor in Manhattan, I have the privilege of working with spectacularly successful options traders that know how to exploit market panics that take place now and then inevitably. In this video, we're going to teach you an incredibly simple trade that almost anyone can do to take advantage of unique opportunities that arise in the options market because people are panicking. So if you'd like to learn a really easy trade to add to your playbook on days when the market's plunging, then stay tuned because I think you're going to be surprised at how easy this will be to learn and implement. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so unless you live under a rock somewhere, you're more than aware that the market crashed last week, at one point dropping 15% from its early February highs. The VIX came within less than 1 point of hitting 50 for the first time in over 2 years. When that happens, market fear can hit levels of extreme irrationality, and while everyone is hiding under a rock, smart professional traders see these as huge opportunities. Every options trader's playbook should contain ways to take advantage of these off-the-charts fear situations like we had last week. And today I want to discuss a very, very simple example of an opportunity that becomes available on days like last Friday, February 28th, when the VIX spiked to almost 50. So let's first analyze what was going on last week for context. Last week was pretty wild, as over the weekend, before the week got started, there was a ton of negative news about the spread of the coronavirus, with new reports of infections and clusters of infections popping up all over the internet, so that by Sunday evening, when futures started to trade, we were already set up for a wild ride. And in fact, the SPX index, which closed at 3338 on Friday, February 21st, spent the whole week selling off, and by Friday the 28th, just 1 week later, it hit a low of 2855 at one point, a drop of nearly 500 points before it bounced into the close, still finishing the week down substantially. And while all that was going on, the CBOE volatility index, known as the VIX, had popped up to the rare 50 level for the first time in more than 2 years. 50 is a massive reading on the VIX, and while it certainly can occasionally get worse than that, that is usually a fairly good sign that fear has reached a maximum level. So when that happens, professional traders start hunting for opportunities. So let's take a look at a chart of the SPY, the ETF, which is comprised of the component stocks of the S&P 500, and you'll see that SPY has not been to the 277 level in 9 months, and in fact has tested support at the 280 to 285 level several times since then. So most traders would be happy to own SPY at 282, or even better at 277 if it got that cheap. So the first thing that many professional options traders will look at on an enormously high volatility day like last Friday, where the VIX jumps up to the 50 area, is whether an opportunity exists in the options market that would be consistent with their belief that owning the SPYs below recent support would be a great outcome. Now, before we get into the incredible opportunity that was available to the astute options traders last Friday, I wanted to let you know that there are sound, viable, long-term techniques for trading options for income that go way beyond the strategy that we'll be discussing in a minute. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open up a free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Before we get into the specific opportunity that was available on Friday to astute options traders, I want to make sure that everyone's clear on how options work. Now, most of you probably know something about options, but just for a quick review, and this will be really quick for those of you familiar with options, what is known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is trading at. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of the stock he owns at the strike price of that put, again, regardless of what the price of the stock is trading at. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. The seller could lose money on that transaction. But if the stock on the expiration day of the option is not beyond the strike price of the option, then the seller just pockets the premium that he was given by the buyer. He walks away completely free of any obligations. The option, in other words, expires worthless because it was never triggered. Okay, so on Friday at around 10 a.m., you can see that the SPY was down another 4% as it had been plummeting all week, losing multiple percentages of its value every day. And so if you focus on the options that expired on that same day last Friday, you'd see that the SPY options at the 277 level, which are 9 more points below where the market was trading at that point, were trading for $1.67. Now, just so you see how unbelievable that is, I'd like to bring you back to January 3rd, where at the same time of the morning, 10 a.m., the put option on the SPY, located 9 points below the market, was trading for 1 cent. That's right, 1 cent, compared to last Friday when they were trading for $1.67. Well, the put options trading at $1.67 represent 100 shares of SPY, and so you multiply that by $1.67 times 100 to get $167. So if you sell 3 of them in a transaction which is known as a cash secured put, you'd collect more than $500. Now, I'd like you to let that sink in a little bit. On January 3rd, if you sold 3 of those, you'd receive $1 per option for a whopping $3 versus $501. That's the kind of thing that happens when the VIX gets to 50, which is 300 to 400% higher than its normal levels. Now, mind you, your broker will set aside capital on your account for this transaction to make sure that you have enough capital to buy the shares if they're assigned to you, but that's a discussion for our next video. Okay, so let's move to the end of the day, and as you might recall, the market bounced that day off of its lowest levels, and so by the end of the day, the SPY, while still down, closed at a much more reasonable drop to 296. And so what that means is that the put options at 277, the right for the owner of that put option to sell his shares of SPY to you at 277 obviously had no value, as no one's going to exercise the right to sell their shares of SPY at 277 when they're trading at 296, so those put options expired worthless. So what that means is that the trader who sold those puts gets to pocket that $501 that he received for selling those puts 6 hours earlier. And those kinds of opportunities were lying around all over the place last Friday, and astute options traders all over the market were taking advantage of them last Friday. But here's what I consider to be the beautiful part of this trade, and that is that in many respects, this trade was pretty much a win-win no matter what the outcome of the market that day. And I say that because if the market somehow did close at or below the strike price of the put option he sold, in other words, at 277 or lower, he would have been assigned those shares, and he would have now owned 300 shares of SPY and paid 277 for them. But as we said earlier, most traders would love to own SPY at 277, which is the cheapest price they could have paid for SPY shares in 9 months in the middle of an 11-year-old bull market that started actually in 2009. To summarize, the astute trader made an easy $501 just by being aware of opportunities that existed in the middle of a complete market panic like last Friday. And so it's imperative that your playbook contain trades like this that you can use to become successful on days like last Friday, which was a very, very big day for experienced options traders all over the world. Now, having said that, there of course was the possibility that the market could have dropped and those puts could have been assigned and you would have owned those 300 SPY shares. So in my next video, I'm going to teach you a technique that you can employ if you do sell puts and the shares do drop below your put strike, causing you to be assigned shares of stock. So you want to press on the subscribe button right now so that you won't miss that video, because you need to be prepared for every eventuality as a trader and have a page in your playbook for the options that are available to you if you do in fact get assigned the shares of stock. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you head over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you're getting through this free online workshop. So click the link to sign up now and don't miss it.